The stock market is near a record high. That sounds dangerous, mostly because the number is large. Here is the myth. Buying near a high means you are probably late. The S&P 500 ended Friday about 1.6% below its recent record. That is according to Reuters. The fear is timely, but that does not make it statistically correct. Before looking at results, define the test. Compare forward S&P 500 returns after record highs with returns after ordinary market days. Then use multiple horizons, because one dramatic crash is not a complete sample. Fidelity studied daily S&P 500 total returns from 1950 through 2024. It found the average one-year return after an all-time high was 12.7%. For other 12-month periods, the average was 12.6%. Apparently, the market forgot that round numbers are supposed to be terrifying. JP Morgan reached a similar conclusion using price returns from 1970 onward. After record highs, average forward returns were 1.6% at 3 months and 9.6% at 12 months. Those figures were close to returns measured after non-record days. At 24 months, the record high sample actually averaged slightly more, not less. Different methodology, same uncomfortable problem for the myth. Dimensional looked at more than 1,000 monthly S&P 500 observations from 1926 through 2022. About 30% of those monthly observations were new highs. 1 year later, the index was higher 81% of the time. 5 years later, it was higher 86% of the time. None of this means records are safe. The dot-com peak and the pre-financial crisis highs remind us that painful declines can begin near records. But the record itself was not the mechanism. Valuation, earnings, leverage, liquidity, interest rates, and recession risk are mechanisms. A price level is just a location. The market, inconveniently, does not have a legally mandated top floor. This matters because investors often turn discomfort into a timing rule. They see a high, move to cash, and wait for a lower price that may never arrive. That can be sensible if the underlying risk signals are deteriorating. It is much weaker when the entire argument is simply, the chart looks too high. Right now, the better question is not whether the S&P 500 is near a record. Watch earnings, market breadth, Treasury yields, liquidity, and the July jobs report due August 7th. If those weaken together, the risk case becomes more serious. If they remain supportive, the record high label adds very little information. A record high tells you where price is. It does not tell you why price must fall.